All right, let's top Nomura. The Japanese financial giant just dropped its latest half-year results, and we're going to dive deep into what's going on. And really, it all starts with one key number. Here it is, 11.3%. This single number is, you could say, the key that unlocks their entire story for the last 6 months. So what exactly is it? That 11.3% is their annualized return on equity, or ROE. Now, if you're an investor, this metric is absolutely critical. It basically tells you how good a company is at making money with your money. A higher ROE, well, that means you're getting more bang for your buck. And that strong ROE comes from one thing, a really, really good first half. Their net income shot up by almost 18% compared to last year. That's a huge signal that whatever they're doing, it's starting to pay off in a big way. Okay, so let's zoom out for a second and look at the big picture for the entire group. This is where you can really see how all the pieces came together to create such an impressive result. Just look at these numbers. You can see powerful growth pretty much everywhere. Net revenue is up almost 11%. That's solid. But look at the pre-tax income. It's up nearly 26%. That's the real story here. It tells us Nomura isn't just making more sales, they're getting way more profitable. And listen, this wasn't some happy accident. The CEO, Kintaro Okuda, said it himself. Their goal is to consistently hit an ROE of 8 to 10%. So by hitting over 11%, they're not just meeting their goal, they're crushing it. It's a huge validation of their whole business model. So how'd they pull this off? Let's start breaking down the different parts of the company, and we'll begin with a major pillar of their business, wealth management. Now, when you first look at this, you might think, that's kind of flat. Net revenue barely moved and pre-tax income even dipped a little. But hold on. In the world of wealth management, this kind of stability is actually a massive strength. The real story isn't about these small changes. It's about the rock-solid health of the business underneath. And here's what that underlying health looks like. For 14 straight quarters, that's 3.5 years, more money has been coming in than going out. That's pushed their recurring revenue assets to a record high. And the kicker, that steady, predictable revenue now covers 70% of their costs. That creates an incredibly stable foundation for the entire company. Okay, now for the real star of the show this half. If wealth management was the stable foundation, the wholesale division, that's their global markets and investment banking, was where the fireworks happened. This is what delivered the explosive growth. I mean, just look at that bottom line. A 6% revenue increase is solid, sure, but that pre-tax income? It's skyrocketed by over 43%. Wow. This division was the engine that really powered the whole group's profit surge. So you gotta ask, what went so right? Well, it was really a perfect storm. Their equities business had its best period ever, a new revenue record. At the same time, investment banking was gaining a ton of momentum in Japan, and they got a major boost from a big rebound in M&A deals overseas. It was a case of strong trading and a comeback in deal-making, all happening at once. But it wasn't all just explosive growth across the board. The story gets a bit more, well, nuanced when we look at their investment management and their newly formed banking divisions. Let's put them side by side. So both of these divisions actually grew their revenues pretty nicely. Investment management was up over 7% and even hit a new record for assets under management. Banking grew its revenue by almost 10%. But then you look at the pre-tax income, and you see they both fell. So what gives? Well, the simple answer is expenses. Both divisions spent more on things like technology and growing the business, and that ate into their profits, even though the top line looked good. Okay, so let's put all these pieces together. We've got incredible overall profit, driven by the wholesale division. We've got a super stable wealth management arm, and we've got a couple of other areas that are growing but facing some cost pressures. The big question is, what does this all mean for investors and for what's next? Well, for shareholders, the most direct, tangible reward for this great performance comes in the form of this number, 27 yen. That's the dividend that Nomura is paying out per share for the first half of the year. And to put that into perspective, that 27 yen is a pretty nice step up from the 23 yen they paid out this time last year. It's a really clear signal from management that they're confident and that they're committed to rewarding their shareholders. But, and this is a big but, despite all this good news, Nomura itself is tapping the brakes a little. Right in their own report, they basically say that because the markets are so uncertain right now, they're not going to give any forecasts for future earnings. It's a pretty clear warning sign that the road ahead might get a bit bumpy. And that leaves us with the final, and really the most important question. We've just seen an incredible performance. They're beating their own targets, they're rewarding shareholders, but when the company itself tells you the future is cloudy, you have to wonder, was this a peak performance, or is this momentum that they can actually sustain?